What on earth is going on with NVO or Novo Nordisk? The stock price dropped significantly, 20% from the range of 70 down to around 55 today. It's been a tough year for the healthcare and big pharma sectors, unlike many other industries that are performing quite strongly. This trend holds true over the last 52 weeks as well. The reason NVO is continuing its downward trend is that they've now cut their full-year guidance. This is becoming a pretty common theme among many companies reporting earnings lately. So, just a heads up. If one of your companies is coming up to their earnings report, unless they at least reaffirm their guidance and deliver a double beat, meaning they beat both revenue and earnings estimates, don't be surprised if the share price takes a hit. Before we jump right into the content, if you're getting value from this video, please subscribe to the channel. We just passed 50 subscribers, so a huge thank you to everyone who's followed the investment diary. Now, let's dive into it. Why did Novo Nordisk cut their full-year guidance? They cite weaker second-half U.S. sales growth forecasts for their Wegovy weight loss drug, as well as their Ozempic diabetes treatment. Let me show you the impact of this from one of their latest quarters and why it's such a big deal. Their net sales were $86 billion. If you look at GLP-1 South like Ozempic and Wegovy, they are a substantial part of their total revenue. In fact, making up more than 50%. So, this is quite big news. We're not talking about something small, although you probably could have guessed it given the share price drop. If we take a look at what's going on, beyond just the lowering of these numbers, I want to highlight that the free cash flow for the second time has been cut. This will ultimately affect our valuation model. They're now expecting free cash flow in the 35 to 45 billion region. Before this, on May 7th, it was 56 to 66 billion. This will massively affect the intrinsic price. Looking at those numbers in more detail, we can see how strong this company was at the beginning of the year. In fact, Q2 in the first 6 months saw 18% growth. These are very strong operating numbers on both a quarterly and half-yearly basis. But the main thing investors want to see is the outlook, and that is ultimately what has crushed the company. They were expecting 13 to 21% growth. They've now lowered this, and we would argue very substantially, to 8 to 14%. We see the same for operating growth. 16 to 24% is now coming in at 10 to 16%. They've also appointed a new CEO, which may have gone under the radar. But purely from a valuation perspective, they're now trading at a forward pay of 13.1, which is well below their 5-year average of 30.4. That's the lowest it's been in the last 5 years. And if you extend the data, it's likely to go even further. That is one severe undervaluation signal. Remember, though, we don't look at any model in pure isolation. You're also getting a yield touching the 3% point, well above the average of 1.41, and it's the highest it's been in this 5-year period. Again, both signals are pointing to undervaluation on a large scale, and given the yield is substantially higher than what they have historically offered, it's worth highlighting that the dividend safety score sits at 99, which is very safe, in fact, the highest score obtainable. Likewise, when we look at the blue tunnel methodology, which highlights the expected fair price, it indicates severe under. Just look at that disparity between where the company sits now and the bottom end of the blue tunnel. This is something we saw with Nvidia during Liberation Day. The disparity was absolutely enormous, and over time, it went back into a reasonable signal. Now, just because it happened with one company doesn't mean it will follow suit. But what we like to see here is that the expected fair price is actually increasing, moving in the direction we want to see, whereas the stock price of NVO is decreasing and continues to do so. So, imagine this. You're getting a company that is intrinsically worth more and more, but the market is mispricing it and offering an opportunity at severe under. But again, that's only if this holds true in your own investment thesis. If we zoom out to the last 5 years, from 2025 onwards was the only time you could have bought this stock at a severely undervalued level. Prior to that, it was for the most part in severe over. And while we see AD on the valuation gradings, these numbers haven't been updated yet because, as we highlighted, it's now trading at a 13.1 PE. Which makes it well below the sector and, in fact, well below their own 5-year average. These are again signs of severe under. But the market, very similar to United Health that we looked at earlier, does not want to touch this company at all. We're currently in greed. Extreme greed sentiment, and valuations continue to be stretched, with investors piling money into companies with extraordinary forward valuations. Yet big pharma and healthcare are industries where investors are not touching. You could argue that opportunity isn't always found by following the math, and this does look like, at least from today's perspective, a potential undervaluation across both the healthcare and pharma industries. Now, they do still expect earnings per share growth over the next 3 quarters. This is a company that also has a 75% track record with 3 out of 4 beats, and in fact, the beats were in the last 3 quarters. Their year-on-year growth, which we rate as a B, was strong at 24%. well above the sector median, as well as their own historical average. But now it's expected to drop from the 21% to the 8 to 14% region, which at a baseline will be above the sector's 8.1%, but a little bit lower than their own 5-year average. So, clearly, we need to incorporate into our margin of safety, which we'll get to later, whether we believe this is an isolated event and they can start to pick up that growth forecast into 2026, or if this issue is here to stay. EPS is anticipated to grow by 13% in the next 3 to 5 years, which is above the sector at 11% but below their historical 15%. It's always good to remind ourselves that this is a very profitable company. In fact, a profitable industry. They have an A+ on grading, with an 85% gross margin, well above the sector at 59%, and an improvement to their historical 84%. Although marginally, their bottom line is 35%, while the sector is burning through cash at -2%. Again, this is an improvement to their historical 34%. So we are seeing slight effect. Cash from operations is $19 billion, well above their average at $12 billion. And again, reinforcing that the sector isn't great, losing $10 million. Now, as always, we want to highlight, is this an isolated event for NVO, or are we seeing something similar in other pharma companies of a similar size? We're looking at the total return with dividends reinvested over the last year, and we're seeing they're down 56%. That includes reinvesting those dividends, which is not great at all. But they're one of three, alongside AstraZeneca and Merck & Co., that are down this year. Extending it to the last 5 years, they're actually one of the better performers, up 77%. Not the greatest performance, not the worst. Novartis is alongside them, up 78%. Likewise, if we compare it against the last 10 years, they're up 133%. Again, not that great, especially given, as we're about to show, the underperformance against the S&P. AstraZeneca is actually looking decent, up 203%, but it's worth remembering that past performance isn't an indicator of the future. As we can see, there's clear underperformance. NVO is down 45%, while the S&P is up 17% and the QQQ is up 23%. Over the last 5 years, we do see a fairly similar performance against the QQQ. And over the last 10 years, we do in fact get to see that underperformance. So, unless you have faith that they can massively outperform, you could consider a low-cost ETF like VU that tracks the S&P. Institutions hold 12% ownership. We saw $6 billion in selling over the last year, a little bit more buying at $7.2 billion, but a lot more buying in Q2. So overall, and in the more recent period, they have been net buyers, which is a little bit more bullish. When we look at super investors, 4 of them hold this company within their own portfolio. Nothing yet for Q2. But as always, when that data drops, we will highlight and alert you. So make sure you are subscribed and your bell notification is on. Now, when we look at revenue over the last 10 years, it has been very strong, going from $16 billion to now sitting at $40 billion, but it's always great to understand what the bottom line net income tells us. Is the trend continuous for both revenue and net income? And for the large part, the answer is yes, because we see net income triple from $5 billion 10 years ago to now just over $14 billion. And we can see the trend is expected to continue at $15.2 billion on a trailing 12-month basis. One of the other things we love to incorporate is a quick health check. Total cash versus total debt. Cash has doubled from $3 billion to now sitting at $6 billion. As always, one number here in isolation will tell us nothing. So, we compare it to their total debt, numerically, and direct, which has actually increased substantially just in the most recent year, going from $156 million to now sitting at $17 billion. Given this sits significantly above their total cash, it's something we would say warrants further consideration, and we'll get to the net debt to EBITDA metric very soon. If you're also worried about a potential recession, in the last one, they actually increased the dividend in 07-09. They had plus 6% sales when the S&P itself was minus 12%. And they massively outperformed in terms of return, minus 27% versus the S&P's minus 55%. They have historically, not saying it will continue, been very fast in growing the dividend. 22% trailing 12 months, 22% again on a 5-year basis, and 16% in the last 10 years, whilst also being a dividend aristocrat, meaning they've been increasing those dividends for 25 plus consecutive years. As we've been discussing, the dividend, also worth flagging, has a free cash flow payout below 60%, which gives us faith they can continue double-digit increases. It's gone to 73% in 2024. Not too great, but it's nice to see the drop anticipated to 60% in the next year. Free cash flow growth, consistent year over year is what we want to see. We get it for the large part, with the expectation for this to continue over the next 12 months. In sales growth, more often than not, at least in the more recent period, we see double digits. Remember, for this full year, they are projecting around 8 to 14%. When we look at ROIC, return on invested capital, very, very strong. Incredible numbers here. 10% at a bare minimum is what our criteria is, just to give us faith that management is able to effectively allocate their capital. And then margins also look strong, operating well above 12%, increasing over the longer term. That is a criterion of a high-quality company, and no worries whatsoever on the free cash flow margin. Now debt-EBITDA NVO has it at 0.5, which isn't that bad, but what we would say is that debt has been increasing at an alarming rate in just the last year. So we would add a little bit more in terms of the margin of safety that we're going to get to for the valuation. Next up, we're going to discuss the intrinsic value at $53. We're going to look at two different discounted cash flow models, so you can select whichever one is most appropriate. Now, for the first one, what we want to say is we've used the 2025 position as the lower rate now after their guidance. This sits at $6.5 billion. That is a massive drop from 2024, and we can see 2024's figure was in fact an 11% decrease from 2023. The average sits at 10%. We've gone with 14%. As you can see, low, medium, and high numbers are in fact subjective. You can always grab a copy of this model by clicking on the pinned comment below and running it with your own numbers, whether it's for Novo, Nordisk, or any others. At 14% with a discount rate, we get the present value of future free cash flow and terminal price. Add that together with the cash, subtract total debt, and we get to the equity value. Divide by shares outstanding, giving us $53, which is a downside of 2%, pretty much around the fair price, because, right now, based on their lower guidance baked into the numbers, it's 14.4%. We'll also flag for transparency and consistency that at the 12% level, it's $46, a downside of 15%, and at 16%, we can note $60, an 11% upside. Typically on the channel, we like to use the middle rate, which is 14%. Remember, this massive drop in intrinsic value is due to the enormous cut they've continued to make to their free cash flow expectations. But what we're highlighting is that right now, we see it fairly valued based on those numbers. Wall Street has continued to lower their price target, so don't be surprised if this continues to drop over the next few weeks. Right now, Wall Street sees an $82 target, giving 52% upside. And if we use a 10% margin of safety, which is typically our starting point, and we execute if it meets our 3 golden criteria-wide moat, strong financial metrics, and good forward-looking data, it becomes a buy at $47. At 15% margin of safety, it's a buy at $45. At 20%, a buy at $42. And at 25%, we can see $39 right now. Though, based on their drop, we're seeing this at its fair value. Wall Street themselves see an upside of 52%. Give us your thoughts on this first DCF model, whether you see it as a buy, hold, or avoid. Now, if we go on to this DCF model, which is, in fact, the same as the previous ones where we have the original $10 billion free cash flow, this can be used if you believe that. Yes, it is lowered, but ultimately, they will revert back to the numbers they had originally estimated. Then you can see here the numbers and the implications. At 14%, it's $82, with 52% upside baked in. Though right now, on this older model, it's 7.4%. And again, for consistency, at 12%, it's a buy at $72, with 33% upside, and at 16%, it's $93, with 72% upside. Now, again, if you do believe this is the model we should use, and that they will revert back, then the middle rate will give a margin of safety today and is pretty much in line with Wall Street and their estimations. At 20% margin of safety, it's a buy at $66, at 30%, $58, at 35%, pretty much where we see it now. Ultimately, Wall Street still sees the upside at 52% to $82. Let us know your overall view on NVO, a buy, hold, or avoid. With that, I think I'll leave it here. If you got value from this video, please subscribe to the channel. If you agree or disagree with anything I said, let me know in the comments below. And if there's a company you specifically want me to dive into, let me know in the comments section too. I hope to see you in my next diary.